Welcome. You are listening to Purpose-Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casino, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose-Driven Wealth. I'm your host, Mo Bina. Today on the show, we have David Chan. David has over 7 years of experience in finance and technology across agribusiness. He's a chief client officer and a founding team member of the company FarmTogether. FarmTogether enables accredited investors and institutions to invest directly in high-quality farmland assets. David, welcome to the show.
Thanks, Mo. So glad to be here.
Yeah, thank you for coming on. Could you please start us off by talking about your background more and also talking about how you became involved in the farmland space?
Absolutely. I think, for me, it's a little bit circular, as life often is, but I grew up in New York's Hudson Valley, so I was surrounded around agriculture my whole life. We were the original apple country before Washington created high density planting, and now they've blown us out of the water. But so I grew up in apple country, and I also got to experience some really amazing weather as a kid. Thunderstorms, blizzards. My personal favorite is thunder snow. It's literally what it sounds like. It's when there is thunder while it's snowing. It's pretty rare, but amazing. So growing up in that environment, I just became hooked on weather. When most kids were watching Saturday morning cartoons, I was watching the Weather Channel, Jim Cantori. I could name every single meteorologist on there. And so that was what I studied in college. It was a no-brainer for me. I was an atmospheric science major at Cornell, and the plan was to pursue a path in meteorology and continue in academia. While I was doing undergraduate research, I realized that we already know so much about how our climate is changing. And really the missing link, in my view, is practitioners going out there in different industries and using that information and making a difference through action that will actually be meaningful towards not only climate mitigation, but also adaptation. So I sort of made a beeline out of the academia path, and I looked at different industries and different functions. And industry-wise, I found agriculture to be so unique in that it has this circular relationship with climate. The way our climate is changing is going to impact what we grow and where, and whether certain crops will be suitable in certain areas in 10 years, 20 years, 50 years, 100 years. But similarly, the way we manage our land can also positively or negatively impact emissions and ultimately the trajectory of our changing climate. So I can't think of another industry that has that circularity, which is why I picked agriculture and went back to my Hudson Valley roots. Function-wise, I think investors are incredibly positioned to make change. They literally can control the decision-making and actions of a private entity and how a private entity chooses to behave, obviously within the realm of some constraints like regulations and safety and whatnot. But there is so much breadth of decision-making that goes into how a private entity decides to conduct business. And so I thought investors have outsized ability to make a change. And that's sort of how I married the two and decided ag investing makes a lot of sense. I started my career in finance, working in an investment bank. And then I later was an early stage employee at an agricultural AI company called Grow Intelligence. And I went to business school after that and received my MBA from Harvard and used that transition time to really focus more on investing and combining those two experiences in finance, technology, and agriculture to position myself to be prepared for a career in farmland investing. I started in a ag private equity firm investing in agribusinesses, and then later met the founder of FarmTogether and heard all about what he was trying to build and what he was trying to accomplish by making farmland a more accessible asset class for both retail and institutional investors. And it made perfect sense to me. So I joined very early on. I've been with FarmTogether now for about 4 years. I'm on the founding team, and it's been a great journey ever since.
Oh, that's great to hear. When you talk about farmland assets, what exactly are we talking about? Just to kind of give more color to the listeners.
Agricultural real estate. So farmland is bare land that is used for agricultural production. It can be literally dirt. That would be a row crop farm where there's no long-lived asset. It's just land, and a tenant or a grower will plant whether it's wheat, soy, corn, beans, some form of an annual crop every single year, and harvest and repeat that process. The other type of farming would be more specialty commodities or permanent plantings where there is a long-lived asset on the property. So now we're not only valuing the bare land value of that property, we're also valuing those long-lived assets that sit on top of that land. Those are almond trees that maybe we're underwriting for 40 years, or walnut trees that can be economically productive for 60 years, wine grape vines or table grape vines. So it's a much broader group of commodities ranging from tree nuts to tree fruit to citrus. And it encompasses dozens, if not probably hundreds of different commodities and items that you would find in your grocery store. When I consider the two, if we wanted to make an analogy to say real estate, I think row crops would really fall more into a sort of that core bucket where it's a bit more homogenous. I think it's, there's still some alpha opportunities, but it's more of a beta play. It's a lower risk profile, lower yield. Permanent plantings and specialty commodities, I think, are quite a bit more differentiated. There's a lot more opportunity to generate alpha, and you have to consider every specific market differently. So it's quite a bit more complicated, I would say, given that you're dealing with fundamentals across, again, dozens, if not hundreds of different commodities. The variability on price, the variability on yield is also quite a bit higher. And also, at least in the United States where we invest, the row crop market is heavily subsidized. 40% of farm income is subsidized by the US government for row crops. Specialty commodities, permanent commodities, those long-lived assets like tree nuts, tree fruit, very few of those markets are subsidized. So they are independent, and the margins just tend to be so much greater because there are very limited places in the world where you can grow many of these commodities. And so the structural positioning of these commodity markets is just completely different than, again, something that's a bit more homogenous and can be grown in many different places across the world. And so again, it lends itself to a bit more differentiation, and ultimately that leads to higher risk, but also much higher yields than what we see on the row crop side.
I see. And so as a whole, how has this asset class performed over the last decade or more?
So we track an index, again, making an analogy to real estate, but there's a common benchmark in real estate, which is the NCREIF index. Mm-hmm. And the NCREIF has a farmland index, which tracks institutionally managed farmland investment properties. And so that's our benchmark that we use. And we have data from the NCREIF farmland index dating back to 1992. So it's a pretty significant time series in length. From 1992 to 2022, so pretty recently, the average annual return of the farmland NCREIF index was about 10.7%. And the volatility or standard deviation of that composite was about 6.6%. So we're dealing with an asset class that has, over a period of 30 plus years, been able to achieve pretty meaningful returns consistently with less variability than many other asset classes. The other item to note is that farmland tends to be a great inflation hedge because there tends to be a very strong correlation with CPI. The correlation to CPI for farmland during that same period was about 0.17, compared to most other asset classes that have negative relationships with CPI, like equities and fixed income. And so, if you simplify it and wonder and ask the question, well, why is that the case? Agricultural products go into so many different durable goods and consumer goods. Obviously, they're used for food, they're used for feed, but corn and soy can end up in so many different products, from pencils to cups, straws. We're consuming agricultural commodities so many times in a given day in ways in which you would not expect. And so that is why there is such a close tie to CPI and inflation, and why many investors recently had been looking at not only real assets, but real assets like farmland that historically track CPI closely and can serve as a pretty strong inflation hedge. The other sort of final note that I would make about asset performance for farmland is the fact that farmland can be a great portfolio diversifier. So farmland is negatively correlated with equities, fixed income government bonds, and REITs. And the only positive correlation among major asset classes that we've seen is a moderate relationship with real estate, which makes sense because farmland does have an appreciation component of return, just as real estate does. But otherwise, we see negative relationships ranging from weak negative relationships to actually moderate negative relationships with some of these other major asset classes. And so adding farmland to one's diversified portfolio has so many other benefits just from a diversification standpoint, and reducing portfolio standard deviation and ultimately making a more efficient portfolio.
Oh, great. It's when you're talking about the negative correlation, let me see if I understood that. So it's negatively correlated, we said, with equities, bonds, and did you also say treasuries as well too?
Yes, government bonds, so treasuries would fall under there, and REITs as well.
Okay. And how is value created in the farmland space when you go out and acquire a piece of land or maybe an existing operation? How is the value being added at that point or being created?
Value add, that's a great question. So value add, I think, will obviously differ from one manager to another. I think for us, we sort of have a couple of different big buckets that we like to think through and consider as our value creation levers. And I would say that those are farm regeneration, water security, price risk mitigation, climate risk mitigation, and our exit strategy. So those are the various buckets that we really think through at FarmTogether in how are we going to add value to these properties. And so, what do all of those really mean? Ultimately, you have two return streams in a farmland investment. The income return, which is going to be derived either from rents that you receive from a tenant who you lease the property out to, or from operating income, and you're operating the asset directly, or you're hiring someone to operate the asset for you, and you take commodity risk and market risk and price risk. So that's the income return. The appreciation return is going to be that unrealized component that, of course, you only realize upon disposition or sale of the asset. But that is also another return stream. I think these different value add drivers that we have, some of them can impact the income return, certainly, but many of them are oriented more towards maximizing that appreciation return, maximizing the long-term value that we're creating at the asset. So when I think about income return value drivers, it may be concepts like farm regeneration, which is a longer-term stewardship value driver, which we think will lead to outsized appreciation. But if we do take on regenerative practices like introducing cover cropping or eliminating the tilling of properties, or adding some agroforestry and planting some trees or different types of trees in between agricultural rows to add biodiversity and increase the immunity and disease resistance of a property, we decrease our need and likelihood of needing inputs like pesticides or herbicides, which cost us money, right? So that is part of your cost of goods sold, or COGS. Anytime we can eliminate or reduce the number of inputs we need, we're reducing our COGS and we're increasing our margins. So that can even a long-term value driver like introducing regenerative farming principles, which we know will ultimately increase soil health and increase the value of the property and help us on the appreciation return. We also think that there are ways in which that type of practice could help us on the income return. again, by reducing the need for inputs and ultimately helping our margins by decreasing COGS. Another example of a value add driver, again, another one that I think would be more long-term oriented, would be on the water security side. So especially in our portfolio, where we are very active on the West Coast in states like California, Oregon, Washington, we look at water probably that's where we start for all of our properties, and that's where we spend the most amount of time. It's not always, I think everyone thinks California and we're thinking drought. And yes, obviously we're in California specifically, we're evaluating which district and subbasin of property falls in, and what are the different riparian rights and options for groundwater, surface water. Of course, we're looking through that. But there are many other places in the West, especially as you start to head up north into the Pacific Northwest, where the concern actually becomes flooding. And we have so much water. Does it actually drain properly? Do we have a proper tiling in place so that we can capture that water in the aquifers? And it doesn't lead to runoff, and it doesn't lead to pooling or ponding or stressing of the trees that may ultimately, again, hurt our income return by hurting yield, and hopefully not, but could hurt our appreciation by degrading soils or even hurting the long-lived asset health, the tree health. So we evaluate water security extensively, and we'll think about how can we mitigate or improve the water health of a property. Does it have the most up-to-date irrigation technology? Is it properly tiled? Are we considering all of our options in water banking? Could we generate more revenue for a very secure water secure property that has excess water? Perhaps we can sell some of that excess water, the credits to that water, to other growers who need water, and generate additional revenue for our investors on that property. So there's lots of different ways to create value if you have under the lens of water. If you make all of the procedural changes that need to be done to maximize water efficiency and security at the property, and capitalize on properties that again may have excess water, and that's a store of value. That is in and of itself a commodity that can be potentially monetized. So those are some examples of value drivers that we see.
Oh, great. Thank you for getting into the details, especially on the water side, because that's, I heard somebody one time tell me that without water, farmland is useless. It has no value really. So thank you for getting into all that. One of the things that you mentioned a little earlier on was about the price risk mitigation. Can you kind of elaborate a little bit more on what exactly you mean by that?
Yeah, absolutely. So for price risk mitigation, I think some of the more common techniques or options that we think through, strategies that we think through, would be securing long-term offtake agreements, long-term contracts, working with buyers that we know and we're well familiar with their consumer base, their buying base. And this can be especially true in some of the more, I would say, specialty or branded commodities. So like wine grapes is a great example of this. Working with a great winemaker, where you understand what labels they support, who are their end buyers. That's critical. And securing those long-term agreements, I think, de-risks quite a bit of the cyclical risk that you have in any given year from different factors, from disease to, even in the wine grape market, smoke taint has been a pretty big risk in the past, where we've had wildfires, especially in California. Plumes of smoke have traveled. The smoke actually penetrates into the fruit and gets into the taste of the grape. And so winemakers then can do very little to use those wine grapes as far as commercial production. So long-term offtake agreements are another way in which we mitigate some of those risks. I think also, again, just diversification. So diversifying across our marketers, across our packers and processors. We don't want to work with everyone. We like to sort of, do a lot of diligence and build a lot of trust and understand who we're working with. but also not just work with only one entity, because obviously that in and of itself is a risk. And so, we find often having a handful of trusted marketers, packers, and processors that we work with to be really beneficial. And you get the best of both worlds. You know those folks really well. You understand their operations. You give them, obviously you're able to give them more business because they're one of a few, not one of many. But at the same time, you're not beholden to only one marketer or one processor, and you are able to also just benefit from that diversification, and mitigate that counterparty risk. So that would be, I would say, those would be some of the examples I think when I think about how do we mitigate price risk.
I see. And then do you ever do any type of hedging through like buying futures contracts?
We don't. There are, I think there are some options out there. Especially when we directly operate our properties, which we often do for permanent commodities, part of the going deep on diligence in understanding who we're picking as an operating partner. And with our operating partner, they're not only doing the growing for us and the agronomy, they're our marketing partner. They have the relationships with processors. It's the full gamut. So part of that research in understanding who we're doing business with when we select that operating partner is leveraging their expertise and their basically their ability to either leverage hedging or addressing that type of price risk mitigation. And so one common thing that we do with our marketers is called pooling, where you'll harvest all of your tree nuts or fruit, whatever the commodity may be. You'll complete harvest, and everything will be picked and stored, and so you'll know what your final yields were, but you won't necessarily distribute that at the same time and contract that at the same time with your buyers, because you may end up locking in at what is a cyclical low price, and had you waited for 3 months or 4 months, you may have benefited from a higher price. So we like to try to smooth out that price risk volatility, and our operating partners do this for us, where we'll elect and we'll work with them and their recommendations based on what they're seeing in the market. We'll elect, maybe we have a third of our commodity sold through a first pool, a third in a second pool, and the final third through a last pool. And those pools are spread out across a couple of different months. And so we're getting different price points on different parts of our produce. And that's just beneficial, again, to, hedge against the risk of, just kind of being unlucky and selling everything on the one day that prices, for whatever reason, were at their, near-term low.
Yeah, it makes sense. And how do you source your investment opportunities?
Our sourcing is very much tech enabled, and so we have a proprietary tool called Terra that we've developed in-house. So Terra considers lots of different variables, from scraping thousands and thousands of broker sites to see what on-site or listed properties are available and how those may be changing, what the trend lines are. We look at typical real estate indicators like listing to under contract times and whether or not there's price cuts or price adjustments. So we look for all that information to have an understanding of the relative temperature of the market and whether it's shifting from buyer to seller, seller to buyer. We also look at a lot of other different variables as well. We look at variables to try to unlock off-market opportunities. We found many compelling investment opportunities through our off-market channels. We look at different sale comparables to understand, again, just relative valuations and how appreciation has been tracking as of late. So Terra is sort of our, I would say our secret sauce that allows our investment team of half a dozen folks to do the underwriting and do the work that, you probably need 600 people to do pre-technology. So we filter through hundreds, if not thousands, of properties every single week. And our job is to basically eliminate a property as quickly as we can. If we know that a property isn't going to meet our investment objectives or criteria, we want to eliminate that from consideration as quickly as possible to preserve our team's time to spend on the very, very few properties that may meet our criteria. Historically, we select about 1%. I think it's a little under 1% of properties that we identify as available. And so, we want our sourcing and investment teams, brilliant minds, to be spending all of that time on sort of that final slate of candidates that we have really high conviction in, and that's where we want to potentially go into escrow and spend time doing diligence and ultimately acquire those properties.
Okay, and where are your farmland assets? Where are they located? What geographic areas?
We're all US right now, so just in the United States. We tend to skew more towards the West. Our portfolio is about 80% specialty and permanent plantings and 20% row crops. So we have properties in Washington, Oregon, California, Idaho, Colorado, and then also we have a handful of properties in the Midwest, like Illinois, Nebraska, and Oklahoma as well.
Okay, great. And people have increasingly kind of realized the importance of and place greater emphasis on food that's grown organically and that also is non-genetically modified. When you go through the process that you described of kind of identifying available properties and going through that pretty extensive upfront legwork, how do you factor in like the fact that there's this growing desire and demand for organic and non-genetically modified crops and so forth? How does that kind of formulate into your selection process of potential properties to go after?
That's a great question. I would say specifically with labeling, and questions like, does the investment in maintaining an organic certification or transitioning certified organic make sense? Or any other type of label like non-GMO or biodynamic or whatever it may be. We look at labeling decisions and questions through the lens of really, I would say, acting as a fiscally responsible manager. So we are only thinking about investment return at that point. We're only thinking about whether or not this is accretive to an investor's return on the property. And so we look at pricing and we look at organic premiums or non-GMO premiums, and does that premium that we see in pricing, and also we'll look at comp sales and appreciation. Does the premium we see either on the income return and or the appreciation return justify a use of resources, a use of whether it's dollars that we need to transition or yield that we may need to sacrifice in order to support that type of label? Does it support that? And if it's accretive, I think there's a strong case to be made to move forward in that direction. If it's dilutive, I think it's challenging to make a case for why that would be a good outcome for our investors. That's separate from sustainability. I think one big misconception among lots of consumers and folks who aren't as in the weeds in farmland, is that these labels somehow signify we as consumers want the label to do the work for us. And I want to support sustainable farming or sustainable agriculture, but I don't have the time to do full diligence on where everything is grown. So I'm trusting a label to do that work for me, right? That's ultimately, I think, what goes through the minds of many. But what we've seen and how we think about sustainability in farmland is ultimately just, are you leaving the land better than you found it? That's simple and a little cliche, but that's ultimately how we think about sustainability. And we've seen many certified organic farms that we would argue are not leaving the land better than how they found that land. And we've seen many conventional farms that we think are. So I think it's too broad of a concept to narrow down sustainability to one given label. Our approach is actually a very comprehensive one. We've enrolled all of our properties in a standard called the Leading Harvest Farmland Management Standard. It was a standard that industry created. So the leading institutional investment funds in our space created a roundtable and worked on the standard over several years. I was actually interning with PGIM at the time that this roundtable was occurring. So I had a very, very, very tiny role to play in the early part of beginning this standard. But it's been amazing to see it mature, and it's now been rolled out, and we've enrolled 100% of our acres in Leading Harvest's farmland management standard. And the reason why I like this approach for sustainability in our industry specifically in this asset class is because of two factors. One, farmland is very broad. Again, we're talking about hundreds of different commodities in hundreds, if not thousands, of different locations. How do you define what sustainable corn growing in Kansas is compared to Minnesota? Those are two different climates, two different topographies, geographies, and needs. It's very different. So I think it's hard to rely on a label to be able to capture that. The other factor, and the reason why we selected Leading Harvest, is because there's a third-party audit procedure that's required if you were to conform with the standard. So we actually have a third-party auditor who randomly selects different properties in our portfolio and does on-site audits every single year to ensure that we are conducting operations in a way that's consistent with the standard. I find this to be a very objective approach to addressing sustainability, and a unique one. I too often see, whether it's in our asset class or in others, claims of different sustainable practices being done or being undertaken, and they're often wrapped into an impact report and tied with a nice bow. And the author of that impact report works for that manager, or better yet, maybe on the marketing team at that manager's firm. I'm not saying that those aren't objective, but it's a little harder to justify, or I think to make a case for why that's an objective assessment of sustainable practices. It would be like a company saying we're going to provide you audited financials, but we did the audit ourselves. I don't know if investors would necessarily be appreciative of that. So I know that was a little bit beyond what you were asking, Mo, but I think at the surface level, when we think about specific labels, first we ask the question whether or not we think there's a commercial reason to pursue that label. Is it accretive or dilutive to the investor? But addressing that connection to if this is a sustainable practice or not, that's a whole separate discussion, and we have a much more comprehensive and, I would argue, objective approach for addressing sustainability.
Yeah, no, I appreciate you getting into the details, because basically, to kind of sum up what you were saying, or part of what you were saying, is that just because you are labeled or you have the designation of an organic farm does not mean that you're engaging in regenerative farming practices, for example. And so just because it's organic, you may be checking all the boxes in order to be labeled as organic by the USDA, if I think that's the right agency that kind of administers that. Then at the end of the day, are you really leaving the land and the soil, and whatever environment or land that you're utilizing to grow the crop? Are you leaving it in a better place than it was before? And if you're sucking up all the nutrients in the soil, then now you got to come back and you need to add nutrients artificially, right, to the soil. Versus if you're engaging other types of practices, then that, basing on what you're planting and how you're growing things, those things are automatically being organically or regeneratively done on their own. Is that correct?
Yeah, ultimately I would boil it down to, many organic growers and organic farms are operating sustainably, but not all. And so my argument is more so, I'm certainly not saying that, most organic farms are not sustainable. No. What I'm saying is these are specific labels. They're the consideration for what designates that label is finite and is not as comprehensive as a broader approach that considers many other factors beyond just agronomic or growing factors, but also community factors, labor factors, safety factors, much broader than just input use or seed selection, some of those common criteria in organic farming. So I don't think it's appropriate to use labels necessarily as a bellwether for whether or not a given commodity was produced in a sustainable fashion, because in my view, one cannot say with certainty or assurance that a label, at least most of the consumer labels that we're familiar with, has a comprehensive approach to at least to the factors that we consider when we think about sustainability.
Gotcha. And you're basically just talking about looking at it holistically.
Exactly.
Yeah, that totally makes sense. How do you help investors participate in farmland investments?
So the mission and vision of FarmTogether is to enable more and more access for both retail and institutional investors to benefit from the stability that farmland can provide to a portfolio and the diversification benefits that farmland can provide to a portfolio. So we have several different products that we offer serving both those communities. We have crowdfunded Regulation D security offerings where an investor can own a fraction of an LLC that holds title to an agricultural property. Our minimum investment size there is $15,000, 15, and the benefit of that structure and that product is that investors are able to select and pick which properties are a good fit for them based on investment criteria, suitability, and also their own preferences. Another product that we have is an open-ended evergreen fund. So that's the FarmTogether Sustainable Farmland Fund. That's a diversified pooled product. So it's a commingled fund. So if an investor wants a benefit of diversification in their farmland allocation, they don't necessarily want their whole farmland allocation in one single asset, and they don't necessarily want to dedicate the time to deciding what are going to be the handful of assets that they end up creating for their farmland portfolio. The fund may be a good option. Our minimum investment size for the fund is $100,000. We also have two other products that are both 1031 eligible. So 1031 may be a familiar concept to investors who have done a lot of real estate investing, but for anyone who's not familiar with 1031 exchanges, there's effectively a portion of the Internal Revenue Code that allows investors to roll proceeds from the sale of a real property into another real property investment. So you can defer your capital gains, you can defer even your depreciation recapture by rolling into another real property investment. I think what some investors don't know, even real estate investors, is that the IRC defines this as a like-kind exchange. And like-kind just means real property needs to go to real property. So you can sell a gasoline station in Louisiana and invest the proceeds of that sale in an apple farm in Washington. And that would be considered like-kind. So we have two products that support 1031 exchanges. One would be our tenancy in common, or TIC product. So tenant in common products have a minimum investment size of $500,000, and investors become a tenant in common on a agricultural property, and so they'll have a residual interest on the deed of a deed title to a property. And the final product would be what we call bespoke or separately managed accounts, and so that would be for an investor who wants to outright own a property, or maybe they have a group of investment partners that they know and collectively they want to buy a single property or build a portfolio of properties. We work with investors to do that as well. That's the highest minimum investment because we need to source all the capital from either one investor or a group of investors. So we typically guide investors towards a $3 million threshold for that product. And obviously, that can change based on preferences, but if we're looking to build a portfolio, it may be even higher than that. But those are our four products. So crowdfunding, minimum investment of $15,000, our Sustainable Farmland Fund, which has a minimum of $100,000, our 1031 eligible TIC product, which has a minimum of $500,000, and then our 1031 eligible bespoke or separately managed account product, and that minimum is about $3 million.
Okay, and again, this is all for accredited investors, correct?
Correct. Yep.
Okay, and David, how can people find out more about FarmTogether?
To learn more about FarmTogether, I would definitely recommend checking out our website at www.farmtogether.com. We've invested a lot of time and effort into making that a one-stop shop for farmland investment education, and also just understanding a little bit more about how our team operates and how we develop our investment thesis and underwrite. the different farmland opportunities that we bring to our investors. And so if you sign up for a FarmTogether account, you're able to access our learning center. Our learning center houses white papers and different analyses on farmland performance in interesting periods, including in recessionary periods. So potentially a timely piece of content, we shall see. But in addition to that, we also host a number of webinars ranging from deal-related webinars where we talk about, again, our investment thesis on a specific property, to more themed webinars, like how do we underwrite water in California? So all of that content can be found on our website and is found at our learning center. Additionally, if investors want to be kept in the loop on new offerings, new crowdfunded offerings, or other offerings as well, once you are on our website and we have an account made for you, you're added to our email list. And so we launch our new deals via email. So anytime a new opportunity is coming available, we let all of our registrants know via email.
Okay, great. Thank you, David, for coming on to the show today.
Thank you so much, Mo. I would also just offer up, if any listeners or investors have any questions and want to contact me, I would be more than happy to answer any questions, and I can be reached at david@farmtogether.com.
Okay, and we'll include your email and also a link to the website in the episode show notes. Well, yeah, thank you again for coming on to the show today, David. You provide an amazing amount of value to the audience. And that's all for today. And thank you, everyone, for tuning in. Until next time, have a great week.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.